Chris, let me take you to a chart of sterling risk reversals. The bearish sentiment in sterling actually staying off levels at the moment, suggesting a no-deal Brexit. That seems to be the talk of the risk of that increasing in the markets. Risky's not reflecting it yet. In the meantime, you've got Investec, Aberdeen, Pictet cutting sterling positions or staying on the sidelines. As we look ahead to Theresa May potentially stepping down, would you be looking to cut your sterling exposure?
Yeah, we have. We've often made the point to clients that people are very aware of equity market risk in their portfolios, but they don't think a lot about currency risk in portfolios. Now, we're sterling reference currency for nearly all of our investors. I think one of the reasons why people don't worry about it as much as they might is because sterling tends to depreciate at times of heightened risk, and actually that gives you FX gains. So, but one of the problems is, of course, Brexit changes all of that. So the pound's been priced off the prospects for Brexit. Now, if a soft Brexit came, then the pound would rally. And that was what was concerning us a few months ago, concerning us in inverted commas. So for that reason, we were actually hedging out FX risk at that point, because we thought that a hard Brexit, this is earlier in the year, was unlikely, at least in the short to medium term. In the last few weeks, I think that's changed entirely. You know, since Easter, since the re-emergence of the Brexit Party, that's reset the agenda. It's reset the agenda within the Conservative Party, which has definitely tacked to the harder Brexit end of the argument, and has got us to this point where May is now out. We're going to have a new leader, almost certainly a hard Brexit leader, quite probably Boris Johnson. Hard Brexit's back on the table, pound down. And so we have actually deliberately taken FX exposure back into our portfolios. Yeah,
and Chris, a lot of people would agree with you on that increase in the hard Brexit or no-deal risk. So, Paul, would you say, having seen that riskies chart, that the FX market at the moment is still underpricing the risk of a no-deal?
Yeah, without a doubt. I think, as Chris mentioned, I think the debate so far has been about this Brexit on, Brexit off. And it's easier perhaps to sit on the fence with FX than it is to make a decision. But now, as you look forward with May going, the chances of a harder Brexit are rising, but also the chances of a general election and a Labour government are rising as well. Both scenarios are probably fairly damaging for sterling.
Right, and we've seen a reaction in the gilt market as well. So the 10-year gilt yield on a 95 handle, we dropped below 1% for the first time in 7 weeks. And also the gilt curve, the 2s, 10s, narrowest since the financial crisis. What does the latest news mean for the way you would invest around gilts right now?
Well, the gilt market is one of those we think is actually pretty overpriced. Now, clearly, this risk-off environment we're in at the moment, this uncertainty about global growth, is good for gilts and it's good for government bonds. Safe haven demand, of course. But if you think about how politics could influence the gilt market going forward, the natural risk reaction from anyone getting into government now would be perhaps to loosen those fiscal purse strings, to spend money to basically reward the electorate that put them there in the first place. So I would have thought if we are going to see a shift towards a stronger, let's say, away from the centre to the right, perhaps within the Conservatives, or even a shift towards the Labour government in the future, then I think gilt yields should creep higher, just reflecting that extra fiscal spend, extra supply, if you like.